All right, welcome everybody. Merrill Chandler here. We are having our breaking news so you don't break the bank. We are talking, we've got kind of a wide array today of news updates, some of them literally as recently as a couple of hours ago. So let's start with the most recent first. Deutsche Bank, a German bank doing business in the United States, is the first large bank, like a big bank, to make basically to prepare its operations for a mild recession starting in fourth quarter of 2022. So we'll see who else might be getting on the bandwagon here. They call it a mild recession because they're basically in the article in CNN Business basically outlined the idea that while we had a 10% unemployment in 2020 and we had a 14% unemployment 14.7% unemployment in 2020 and 10% in 2009 as a result of the Great Recession, we shouldn't push. They're projecting we shouldn't push much past 5% unemployment going from late 2022 into 2024, estimating 18 to 24 month recession, and mostly because of the what they're saying, the Fed has been slow to raise interest rates to calm the overheating of our economy. Now, for those of you who've been on my previous ones, I don't call it an overheating in the economy. I call it scarcity of supplies and lack of supplies in the supply chain. So yes, it is still causing interest rates to rise. It's causing interest rates to rise, and correspondingly, inflation has been going up, but not since the Great Depression of the 30s did we have the lack of supplies driving the costs up, right? So the supply chain demand is what is the big factor in this in the upcoming recession, at least according to Deutsche Bank. Now, the other thing that I want to share is the mortgage payment to income ratio is getting close to the pre-meltdown territory. So I've been saying that we need to be careful that I haven't purchased a home in the last 2 years, mainly because I don't like buying at the top of the market. It's very difficult to short houses. So I've stayed out of this marketplace, but the relationship between income and mortgage payment is becoming perilously, that debt to income ratio, where they consider how much mortgage payment you can handle, is narrowing. For example, the markets with the highest home price increase year over year, Tampa, Florida was 33% home price increase. Everything in the 30s was Tampa, Austin, Raleigh, Phoenix, and Nashville. In the high 20s, from 27 to 29, San Diego, Miami, Las Vegas, Orlando, and Jacksonville, right? So all of these are above, or somewhere between 27% and 33% from a year ago, same period. So the payment, no one's been really offering 40-year payments, right? No one is lowering the price of the payment. No one is putting simple interest, but they're still using amortized interest on these loans, which amortized simply means you're front loading the interest payment over in the first half of the loan payment period. So each one of these factors, the price of a home is gobbling up more of the median income of the people who are buying. Now, yes, the loans are still being manually underwritten. Check. The loans require certain grades of paper. You're paying a higher interest rate if you have less than an A paper loans. Check. They're doing everything the underwriting process is far more legitimate than it was in 2007 and 2008 before the big crash. What is not is that the prices of homes are skyrocketing to capture such a high degree of the income that it's teetering on being out of the comfort zone of many home buyers to be able to continue those payments. And if it's really seriously hand to mouth and paycheck to paycheck. And so everybody's saying this is not the normal set of criteria that would cause a massive foreclosure crisis. But everybody's saying beware, because there are way too much of the median income is being gobbled up by these super expensive homes that have increased by a full third, 25% to 33%. That's 25% increase to 1/3 increase over the previous year. We're paying, each one of those home buyers are paying in their monthly payment 25% higher to 33% higher payments. It's precarious. And so I just keep saying, let's watch it, be careful, look for good deals. I know a lot of our clients are moving more and more towards tax sales, looking for those hidden treasures, right? Farming farming areas to get it before it goes to market, so that they're picking up properties before they hit the MLS. So just be careful. Now, one of the things we do want to make sure that we're covering is that the final notice here is Apple is just made a very, very, very curious purchase. They acquired a UK-based open banking fintech. They $150 million and bought Credit Kudos. Credit Kudos, but by open banking, is it's more implementation of the things that we've talked about in the past, where they're expanding what credit data is being used to make loans. Open banking is where we're not using depository institutions to create banking relationships. Now, what does this do to fundability? Fundability is simply meeting the funding requirements of every institution that you work with. So Apple, right now, Apple is not a depository institution. Any of its loans would be like any other fintech loan and graded at a tier 4 finance company level, right? The fascinating thing is that Apple's credit card, so there's Apple Pay, you go up to pay for something, put your phone, and the Apple Pay is a open banking platform that they're now going to be using Credit Kudos to establish a better underwriting criteria for lending. But Neiman, why do I always call it Neiman Marcus? The Apple credit card is a tier 2 card because the bank that hosts the Apple card is a tier 2 bank. So they've got the Apple credit card over here in tier 2, but they're looking to be a bigger player, the 800-pound gorilla in the fintech marketplace, to begin making loans and consumer type engagements, right? Loans, et cetera. So we've got to be careful, because even though Apple is a household name, the type of credit instruments that they are going to offer are going to always be in the tier 4 marketplace. So how I want to wrap up this afternoon segment is that fundability, by definition, means the ability to get the best possible interest rates for your profile and or business, regardless of where the markets are. So if prime is 3%, and getting a prime plus 0.75 is the best possible interest rate for the best possible personal and business profile, then you are fundable by definition. And then fundability has a bullseye, which is the very best, lowest cost funds. Then there are rings on that circle. You can be fundable on the outer rings, but you want to make sure that you are, every situation is different. So our goal here is to get fundable. We want to make fundability the principal financial and credit operating system that we run our personal credit by and our business. And so interest rates, let's pretend they go to 7% prime. Well, 7% plus 3%, maybe the best possible money out there for business loans and lines of credit would be 10%. But you can pay 10% or you can pay 11, 12, 13, or 15%. Follow me? Fundability is getting the least expensive capital regardless of where prime sits. So let's continue to do everything we can. If you haven't been to the boot camp, go to getfundablebootcamp.com. Make sure that you learn the principles, because after that weekend, you will be able to implement powerful fundability strategy, both in your business and for your personal credit, that it is going to just change your life. So make sure you get the least expensive money possible. The only way to do that is to hit the underwriting guidelines and the approval guidelines, as closely cutting it to the bone as you possibly can. Lenders only make the most amount of money when they lend. So let's let them lend to us by becoming fundable. This is Merrill Chandler, your guide to the fundability universe, and your host of the breaking news so you don't break the bank. We will see you, same Fundable time, same Fundable channel next week, Tuesday at, next Tuesday, we won't be here because I'm going to be on a plane coming back from CreditCon, the credit repair symposium and conference that happens annually. So we will see you in 2 weeks. Thank you for joining us.